Hi, Matt McAleer, President, Director of Private Wealth, Cumberland Advisors, August 23rd, just after the close. Couple quick things. Getting into late August, don't want to read too much into the Jackson Hole event today. I had been surprised by the amount of strength out of Powell's notes that Fed rates would be cut. I thought that had been baked into the market. It's been certainly talked about and handicapped in that direction now for a couple of months. But good, solid strength, really where we've gotten to over the last, 5-6 trading sessions is back to those July highs. So we had that nasty early August dip off of some of the weakness overseas. And I'll tell you, traditionally it takes more than 2 weeks to make a 6.5% S&P drawdown to make it back. Very impressive. One chart I wanted to share with you is how the market has recovered. Remember, for the last year and a half, 2 years, it's been tech, high growth from a relative strength standpoint. If you weren't almost entirely in tech, then you lagged a bit. But as we take a look at this chart, and this is what we call dynamic asset level investing. You've heard me mention Dorsey Wright before, owned by the NASDAQ. They're a relative strength and trend shop. This is showing from left to right, strongest relative strength sectors to weakest. This is a moving target. It's never set in stone, but the point that catches my eye now is for the first time in really almost a couple of years, tech is not a gap length ahead of the other sectors. As a matter of fact, it sits in third. That doesn't have any real concern to me in that if we look at the scores, they're almost identical, 198, 197, 196. Those are relative strength buy signals. Not to get into how those are calculated, the point being it's trying to identify what sectors are exhibiting the strongest relative strength against each other. Look at financials and industrial. We've talked about tech and industrial for quite a while now and is large allocations in our strategies. But financials have really gone on a 2-3 week run here. Initially, it was on the back of the insurance companies, but this week before, off of that lower rate expectation, banks have gotten themselves into gear. So in terms of where we're positioned in financials, over in our U.S. ETF portfolio, KBWB is a holding. That's large banks. That's trading very well. In our U.S. core, which remember, tends to be diversified, we've picked up a lot of bang for the buck out of the financial move within our ETFs, our broader ETFs that tilt value. Then tactical trend, although we sold JP Morgan back a month and a half ago after a nice run, we still have plenty of exposure through our value ETFs, DFUV, DFIV, and Berkshire Hathaway. So we're positioned properly. We're positioned in a reasonable manner. But the most exciting part is the fact that breadth is expanding amongst the sectors. Very important as bull markets thrive on increased participation. So appreciate you joining us. We're going to throw it to the Moose, who has some timely notes on the bond market.
Hi, it's John Musso. I'm the CEO of Cumberland Advisors. It is Friday afternoon on August 23rd. This is the bond report. This week, bonds doing well. 10-year bond started the week at a 388. It is down to a 380. We can thank Jay Powell for a lot of that. The chairman of the Federal Reserve spoke today at the Fed Symposium in Jackson Hole, Wyoming, and he said what everybody thought he would say, that the Fed is looking to start to cut short-term rates beginning next month in September. He talked consistently about things he's talked about before, analyzing of data, balancing of risks of inflation versus lowering of growth. And he's going to continue to do that. We're going to have another employment report before they get to that next Fed meeting in September. But he told you that they are going to start, and that helped bond markets. It helped muni markets not nearly as much. Muni yields hardly moved at all this week. On the long end, not at all. Short end, they moved down. Short rates moved down here, and treasuries as well. So the 2-year treasury is now down to basically a 3.90. Remember, it wasn't that long ago, it was 5%. When you look at it, though, you still had numbers this week that would suggest slowing in the economy. Various manufacturing indices, Philly, New York, down, a non-manufacturing industry with Philly down. We saw revision on the jobs numbers with the Bureau of Labor Statistics saying that about 800,000 less jobs have been created than originally reported on a cumulative basis. So those things all kind of add to the fact that the economy is slowing, and the Fed acknowledged as much. We think that the Fed is really trying to get out in front here, and they're certainly allowing for more rate cuts. The question the markets will be dealing with as we move forward, of course, will be what kind of rate cuts, 50, 25, do we get 100 basis points of rate cuts between now and the end of the year? Questions that the markets will grapple with. We think the important thing is that there's a little bit of wind in the sail in the bond markets. We'll have to grapple with inflation numbers, but there's no question in our view that the tail risk, and when I say tail risk, I mean that the risks that the markets have dealt with over the past year, that inflation could raise its ugly head, some of that risk is being diminished away. And it doesn't mean that you can't get really bitten on the rear end by a bad number in inflation. But the market seems to feel that we're on the other side now of the mountain, with inflation declining and certainly with the economy cooling down. Remember, at a 3.80, that compares to a 4.70 just in April on the 10-year Treasury bond. And even as long ago as the end of June, when President Biden had the bad debate performance and then pulled out a couple of weeks later, you were even back then at around you went to a 450 when it looked like you might have a sweep by the Republicans. Some of that has come off the table. You had the Democratic convention this week. It certainly has a much different feel in the political markets, if you will, that you could get divided government. So in other words, not the Senate, the House, and the White House all on the same side. That has also added, we've talked about it before, to this feeling that, the inflation could be under control and continue to decline. That's much different when they're all on the same side and people say, oh boy, they're all drunk, they're going to spend money like crazy. That has gone away. We don't get a CPI number until a couple of weeks. It'll be important. We're going to get a money supply number in 2 weeks, and we think that it's important to recognize that even though the Fed is now telling you we're going to lower rates, it's going to be data dependent, as it always is. We hope everybody has a great weekend. We'll talk to you next week.
Thanks so much, Moose. Asset allocation is always a moving target. If you'd like to share thoughts and ideas, never hesitate to reach out. Have a great weekend. Thanks for joining us.